Let's get deeper into what Fed Chair Powell said that sent the markets lower and signals there's pain ahead for the economy.
Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
Well, what exactly is that pain going to feel like? Let's bring in Gregory Daco. He is chief economist at EY-Parthenon. Greg, why do you think the market is finally reacting to what the Fed has, in essence, been trying to say for a while? And what kind of pain are we talking about?
Well, I think what we're seeing right now is that there's a realization via this very crisp and clear discourse that Fed Chair Powell shared that the Fed has this unconditional commitment to bringing down inflation, that it will continue tightening monetary policy, bringing monetary policy towards a restrictive stance in an effort to bring down inflation, and that it will not back down at the first sign of a slowdown in economic activity in the job market. That pain statement was already present in the press conference after the July FOMC minute, was also present in the FOMC minutes. So it's just a reiteration of the fact that to bring down inflation, we will have to cool the economy and we will have to bring about tighter financial conditions. That was the clear message that Powell sent today.
Yeah, I'm still trying. You say the pain was in there before, maybe not as many times, though. It's like pain, pain, pain. maybe it took the repetition. But also, gas prices are coming down. You know, we've got inventory buildup at retailers. There was a sense among a lot of people that the work is being done without the Fed having to really, hit us hard, right? Without a lot of pain. So why is that not still the case?
Well, I think what this speech did was make sure that it was short, crisp, clear, and really just to the point in terms of what the Fed's intentions are. The Fed is not about to pivot towards a lower interest rate environment. It's not about to pivot towards a loosening of monetary policy. It wants to keep tightening monetary policy. It is considering the possibility of doing so at a slower pace. That was mentioned in today's speech. But what was clear here is that there is really no desire to pivot towards looser monetary policy. And the fact that this message was very short and crisp, I think, made the point that the Fed is really intent on bringing down inflation and that it will not back down at the first sign of a pain. I think sometimes having fewer words gets to the key message, the key point, much faster than having more words.
So if we're going to have higher for a bit longer where rates are concerned, and if there are already questions about the consumer's stamina heading into Q4, what do you think that means for an economy where, yes, on the lower end, the consumer stamina is in question, but there's also a lot of tightness in the labor markets at a time when a lot of employers are going to be looking for more workers?
I mean, today's economy is in imbalance. There's a strong imbalance between supply and demand. That is likely to continue to be the case for the foreseeable future. But an easing of these imbalances will likely ease up inflationary pressures. As you correctly stated, we have an environment in which on the labor market front, there is very strong demand for labor, but the supply is still not there. And so wage pressures are to the upside. I think what's encouraging in the last data that we've seen today is that we're seeing that consumer spending growth is cooling. And along with that cooling in consumer spending momentum, we're seeing some easing in the sequential momentum of core inflation. Everybody's focused on the fact that headline inflation actually fell, but that was largely an energy story. Outside of that, the core inflation dynamics on a month-to-month basis are also seemingly cooling. And that's really what the Fed wants to see. The Fed does not want to see pain for businesses and consumers for the sake of pain. It wants to see a slowdown in demand that will bring about slower inflation. And so far, over the course of July, that's what we've seen. That may be a transitory factor, but so far the dynamics are positive.